At 9 a.m. on a random weekday, nothing looks different. People go to work. Markets open. Coffee is poured. But somewhere else, a small group of people changes a number by 0.25%. And suddenly, loans feel heavier. Investments hesitate. Hiring slows. Entire economies lose momentum. Not because anything broke, but because the tempo changed. Central banks don't control money the way most people think. They don't decide prices. They don't order businesses what to do. They don't tell people when to spend. They control something quieter, more powerful. They control when people act. And right now, that timing matters more than ever. For most of the last decade, money moved fast. Borrowing felt easy. Risk felt normal. Delay felt expensive. Then inflation showed up. Suddenly central banks slammed the brakes. And people asked the wrong question. Why are they doing this? The better question is, how are they slowing everything down without touching anything directly? Because once you see it, you realize how little control you actually have over the pace of your own financial life. Every economy runs on decisions made over time. Do I buy now or later? Do I hire now or wait? Do I invest today or sit on cash? That timing is the economy. Central banks exist to manage that timing when it starts getting dangerous. Too fast and you get bubbles, shortages, inflation. Too slow and you get layoffs, defaults, panic. Their job isn't to make things good. It's to keep things from breaking. So how do they do it? They don't touch money directly. They touch incentives. Interest rates are the main lever. Not because of math, but because of psychology. When rates are low, waiting feels dumb. Money loses value over time. So people move faster. They borrow. They spend. They invest. They stretch. Speed increases. When rates rise, waiting feels smart again. Borrowing feels risky. Mistakes feel expensive. So people pause. That pause is the slowdown. Notice what didn't happen. No laws changed. No one was forced to stop spending. Nothing was banned. Behavior changed on its own. That's tempo control. And the most important part happens before money actually moves. A company doesn't fire people the day rates go up. It cancels expansion plans. A family doesn't default immediately. They delay buying a home. The economy slows first in people's heads. Central banks know this. That's why words matter as much as actions. Sometimes more. A single sentence like, rates will stay higher for longer, can freeze activity instantly, not because rates changed, but because expectations did. Expectations are faster than policy. They move at the speed of fear. This is where it gets uncomfortable. Central banks don't need to be right. They need to be believed. If people believe money will be tighter tomorrow, they act tighter today. That's how control works without force. Now let's talk about liquidity. Liquidity is not money. It's how easy money is to access without pain. When liquidity is abundant, markets feel forgiving. Mistakes survive. Bad ideas get funded. Risk feels normal. Everything feels busy, crowded, fast. When liquidity dries up, nothing technically breaks at first. But suddenly, deals fall apart. Margins matter. Weak players disappear. The tempo slows naturally. Central banks add or remove liquidity quietly through tools most people never see. Balance sheets, short-term funding markets, collateral rules. No headlines, no drama, but the effect compounds. This is where the math turns uncomfortable. Debt doesn't just depend on size. It depends on time. $1 trillion of debt at low rates feels manageable. The same debt at higher rates becomes a clock. Every rate hike tightens that clock. Refinancing becomes harder. Cash flows shrink. Survival windows close. Central banks don't need defaults to happen. They just need enough pressure that everyone acts more cautiously. That caution slows everything else. Here's the irony. The public thinks central banks control inflation. They don't. They control behavior that eventually affects inflation. They don't stop prices directly. They slow decisions until demand weakens. It's indirect, messy, delayed, and politically convenient. Because when pain arrives, it looks like the economy failed on its own. But here's the part nobody likes to admit. Central banks are always late. They react to data that describes the past. By the time inflation is obvious, momentum is already built. So they overshoot. On purpose. They tighten more than feels necessary, because stopping too early risks speeding things back up. The economy doesn't respond instantly. It echoes. That echo is where damage happens. Jobs disappear after rates peak. Bank stress appears after liquidity tightens. Recessions are declared after people already feel poorer. Tempo control isn't precise. It's blunt. And the bigger the system, the more force it takes to slow it. Zoom out far enough and a strange truth appears. Central banks don't control prosperity. They control instability. They don't smooth outcomes. They smooth timing. They stretch pain across months instead of days. They delay consequences until they look manageable. But delay isn't removal. Every slowdown creates pressure somewhere else. Every pause transfers stress from borrowers to workers, from asset prices to incomes. Nothing disappears. It just moves, which leads to the real question. If central banks can slow the economy by changing incentives, if they can freeze behavior with words, if they can stretch consequences across time, what happens when timing itself stops working? When rates are high but debt is already locked in. When expectations lose credibility. When slowing no longer cools demand, only breaks fragile systems. Because at that point, tempo control fails. And the conductor realizes the orchestra isn't listening anymore. The scariest part isn't that central banks have this much influence. It's that this system only works as long as people still believe in the rhythm. And belief is the one thing no central bank can print.